Okay, so good morning, everyone. Hope everyone's well. It is Monday, April the 29th, about 8 o'clock in the morning as I'm recording this. What I wanted to put down is just some thoughts for the week, some possible strategies for trades for the weeks. We have a very big week coming up in terms of, just share here, just have a look at this. Here's the term premium. We've obviously got the Fed. We have payrolls data. We have employment cost index tomorrow, which is going to be quite important. We have ISM services, ISM manufacturing. We have Chinese PMIs. We have a couple of speeches by Williams and other people from the Fed. Of course, we have the Fed themselves on Wednesday afternoon. But I think one of the most important things, guys, is the fact that we have the QRA, the quarterly refunding announcement. So that comes in two parts. We have the first part this afternoon at 3 p.m., which is when we're going to get the overall sort of financing estimate. And then on Wednesday morning, probably much more important at 8:30, we have the T-back composition. So that's the composition of the specific numbers and the composition of bills versus coupons or long-term bonds. Just one thing before we look at that, just keep in mind that I think what's going to be a driving theme over the next few weeks and maybe even months is this idea of whether the term premium has to rise or will fall. Now, the term premium is the extra premium or the extra yield which investors demand to hold long-term debt over just rolling over short-term debt. And normally the term premium will rise if the market is uncertain about the future path of growth or uncertain about the future path of inflation. And what's interesting, just have a quick look here. This is on a daily chart going back about a year. And just in terms of the QRA, you can see that when the QRA came out sort of around about Halloween or so, the term premium, which had been at about positive 40 basis points, actually had a pretty big fall of about, down to negative 20 basis points. So about a 60 basis point fall of the term premium, which of course put downward pressure on the nominal yields. And you'll notice that this was a period where we had a huge rally in the stocks. The point is that with the stocks, if the term premium goes higher and higher, that makes it, essentially less attractive to own stocks. There's more reason to be in bonds. The other thing, which is just to keep in mind, is that maybe what we're going to get at coming in the next couple of days is a similar kind of reaction which we had at the end of January 24. So you can see here that maybe the term premium will go down a little bit, and then it could sort of push up. And that's basically what we've been happening sort of, in a disjointed way, but over the last couple of months is the term premium going up, which ultimately is going to put some kind of pressure on the stock market. But let's just have a look now and see what might be expected with a couple of the numbers here. Let me just bring this one up here. So I would say that in general, so the first thing is the financing estimate, which comes today, 29th of April at 3 p.m. And this is a sort of a base case, which I pulled from a damp spring, which is always a pretty good indicator of what's going on here. And then the general consensus is that the estimate, the headline number, is going to be around about 500 to 525. So that's what you should be looking at this afternoon at 3 p.m. is something between 500 and 525. Which was no change in the bill composition of 25% and coupons of 75%. So keep in mind that one of the key issues is that the logic is that bills can be readily absorbed by the market, whereas if there's any change upwards or downwards to the number of coupons, and coupons being the long-term bonds, that will significantly affect the 10-year and the 30-year, that over time, over the next few weeks, should put pressure up or down on the term premium, which of course if the term premium is going up and down, that could put pressure ultimately on the stock market. And that's why this is very, very important. Okay, so just keep in mind that first of all, what a lot of people are expecting is no particular extra coupon issuance. There's also the issue of the TGA, the Treasury General Account, which should be held at about 750 billion. Some people are saying that Janet Yellen, just for political reasons, may be tempted to sort of spend that down. So maybe instead of being at 750 estimate down to 500 or 250, that means there'd be a flooding of cash into the bank reserves, which ordinarily would be very supportive for stocks and asset prices in general. That's not really my base case. Maybe they're going to do that later in the year. There's no real reason for that because we have extra sort of tax receipts and whatnot. But the important thing is just to keep an eye on that. Also important is the gross and the net issuance for the quarter. So as I say, the main thing to keep an eye out for at 3 p.m. Keep your eye on this headline number. Anything less than, let's say, 500 would be pretty bullish for stocks and for bonds. Anything around, as I say, about 500 to 525 billion is consensus. Anything higher than that would be considered hawkish. And the implication is that the Fed, sorry, not the Fed, the Treasury may be forced or may want to issue a higher proportion of coupons or long-term bonds, which of course would not be good. Now that's what we're going to get this afternoon at 3 p.m. As we know, the cash bond market closes at 3 p.m. Is this something which is tradable? I would say it's only going to be tradable if, in a positive way, in a dovish way, if the headline number is, clearly well below 500, so in the 475, something like that. On the other hand, if it's well above, let's say 550, 575, that would be hawkish. But really what's going to be the most important one is probably going to be the number, which is the composition coming out at 8:30 on Wednesday morning, a few hours before the Fed, of course. And what's expected there is the gross issuance of around about $1 trillion, so 1,000 billion, so around about $1 trillion. So the first number, which is super important, is going to be the headline number, which is the gross issuance, around about $1 trillion. Again, anything which is lower than that, that would be very, very bullish in this sort of table here, saying an aggressive buy for all assets. But probably what the market's expecting is that. The other issue is the net issuance of about $500 billion of coupons. So what you need to worry about or to look at is to say, okay, what's the gross issuance? And then to understand what the net issuance is of coupons. If the net issuance of coupons is less than 500 billion, it's expected to remain about the same. It's expected to remain about the same because if you actually look back at what the Treasury said in their document from the last meeting, which actually I have, but sorry, I haven't brought it up on the computer. They said that there is no expectation that for the next several quarters, they will need to raise issuance. Okay, so that a raising of issuance and extra coupons would be a nasty surprise for the market. And again, if you get sort of a gross issuance of 1,100 or 1.2 trillion, something like that, that would be very, very hawkish. That would be, a time to be selling stocks and probably definitely selling the long end of the curve. So that's something to keep in mind there. Okay, so if we get what I expect, which is just to say that, so what's expected is something around about 500 to 525 billion this afternoon in terms of the financing estimate for the headline. And to keep the bills and the coupons in the predetermined, the pre-existing proportion on Wednesday, with a headline of about approximately 1 billion and with about 500 billion of coupons. At that point, we might expect it to get a relief rally. So let's have a look and see what we might be expected to get. So why would we get a relief rally? We would get a relief rally because the idea here is that the Treasury is not introducing extra issuance and is not feeling the need to especially have extra coupons or long-dated bonds. So the point is that what we might expect to be getting is some kind of sort of bull flattening kind of curve. So if we look at a couple of curves here, let's look at something like the 2s 5s, which I think I've got here. Yeah, so the 2s 5s, that could go down to around about the 36 basis points, minus 36 basis points here. That might sort of bull flatten a little bit. If we look at the 2s 10s, which is, where's the 2s 10s? The 2s 10s, that also might flatten down to about minus 40 basis points or so. If we look at the 5s 30s, maybe not such a huge reaction. So most of the reaction is going to be on the probably the long end of the curve. So not so much on the 2s and the front end of the curve, because that's more of a bills issuance kind of situation. It's probably going to be more on the 10s and 30s. So generally you should get like a bull flattener. On the other hand, though, of course, if we do get that extra coupon issuance, so the long-term bond issuance, and we get extra gross issuance in general, that should weigh on the long end of the curve. And so what we should see is that the long end of the curve should come down. So what we should get there is a bear steepener. That's not my base case, and that would be a surprise to the market. If we get a bear steepen, of course, some of these curves are going to steepen. It'll be selling the long end, and probably that's going to be negative for stocks and positive for the US dollar. But let's assume, let's just have a look at a couple of yields as well. So we might get something like the 10-year yield. If we get, no extra surprises from the Treasury, that could be coming down to, around about 4.5, something around about here, and maybe something like the 30-year yield. It could be, coming down to around about the 4.65 area, something around about here. And as I put on my chart here, that could be an opportunity to, if the yields go down that much on the 30-year, you might actually want to be selling some ZBs on the future at that point, on the futures at that point. So that could be the immediate reaction. And the immediate reaction, I think we could consider that for a few days or over this week. Now, keep in mind, of course, we have a huge amount of data and we have the Fed. But I think thereafter it could kind of trade higher in yield. So basically, excuse me. So basically what I'm expecting is that if we get no nasty surprises at 3 p.m. this afternoon and then at 8:30 a.m. on Wednesday, we could have a bit of a relief rally in the bonds, especially the long-term bonds. That could cause some kind of bull flattening. But thereafter, I think the macro will come in, assuming we get a hawkish Fed. And that could be a cause to start selling the long-term bonds again, and then to maybe start putting on some steepener kind of trades. So that's the basic idea here. So maybe, we get the initial trade would be long stocks, long end bonds. And then once we get through this week, it could be a moment to start looking for entry points for bear steepeners and to be shorting the long-term bonds. If we just quickly look over in the European space as well, we can see here that if we look at, let's say, something like the 10-year for the Bund, again, I expect just on the back of the US that could come down here a little bit, could flatten down here. Well, in this case, just go down to about 2.47 or so. And if we look at, let's say, the Schatz, the front end of the curve, the 2-year, again, that could come down to something like, something between, let's say, 2.90, 2.92. There would be interesting areas there to actually be selling. These are the yields. So if it comes dovish, that would be, dovish. And at that point, you might want to be entering to kind of sell. So that's what we're looking out for bonds at the moment. Just talking about bonds, guys, we just had the German CPI data coming in at 8 o'clock, which is a few minutes ago. So I just want to have a quick look at that. We can see here, okay, so prior was 2.2, came in at 2.2 for the headline, so less than 2.3 expected. So that's interesting. The month over month headline 0.5, which is more than last time, but less than expected. And the harmonized, so not too bad, because if you actually look at the German regional CPIs, which we got this morning, they were quite higher than expected. So, but the national one for Germany was not too bad. Interesting there. Okay, so let's just go back to some of the charts. Let's look at FX. Obviously, overnight, we had some intervention by the Bank of Japan, or the Ministry of Finance, I should say, which, of course, directs the Bank of Japan. And now what do we see there? We saw there was a public holiday in Japan. They intervened. It looks at this point as though they intervened before London opened, but after, obviously, sort of the US session, so to speak. So there's the daily chart. You see here the big intervention going down about 2 or 3%. If we put that on maybe a 5-minute chart, we'll get a sense. There's the intervention there, probably about midnight. Very difficult. I mean, a lot of people have been trying to do this over the last few weeks. It was, as I say, a public holiday, low liquidity, midnight on a Sunday. They're going to get the biggest bang for their buck or for their yen. So as you can see, a bit of an intervention there. Some people saying there was a second one as well at about 3 o'clock there. So at the moment, I mean, that looks like the line in the sand is around about 160 on USD JPY. Similar kind of price action here you see in the euro versus JPY. Personally, I think the idea is to leave that alone. But the reality is that the fundamentals are going to be favoring the US dollar at this point, because we have inflation in Japan, which is not really rising that much. We have, just the differentials, the difference in growth between the US and Japan, the difference in the yield differentials is enormous, and monetary policy divergence is huge. I mean, at this point, the market is talking about the Bank of Japan may raise, 10 or 20 basis points, 0.2, 0.3 basis points by the end of this year. Now, whatever happens in the States, there's still going to be a huge difference in monetary policy. So I think at this point, if anything, the market might just be a bit wary for a day or two. But I think at the end of the day, and any dips here, this is a buy occasion. So you'd have to start looking for interesting levels here. I mean, maybe something here like 152, obviously would be sort of a great level. But I think just the macro fundamentals here are going to make it very difficult for the Bank of Japan and the Ministry of Finance over there to keep on intervening, because in the past, there's just too much money and they cannot do it. And I do believe that if, the yen, so the dollar trades down, around about to 152 or so, that would be an incredibly good risk reward to kind of get long US dollar versus JPY. But there might be other opportunities as well. Just looking, let's say, at a 30-minute chart or something like that. Actually, I'm just kind of curious here. Let's put a few technicals on. We can have a look up there. Yeah, so that was the measured move gone. And we can maybe throw Fibonacci on it if you're looking for a good level here. So there's a Fibonacci. You see here the 382 seems to be a zone of interest, or maybe the 0.5. Or again, as I say, this is 0.618 Fibonacci down here, which coincides with that level there, would be a very, very attractive level to be getting in. But that might be a little bit optimistic. But just getting back to some other stuff, if we go just look at the dollar index here, as I say, assuming the QRA, they don't have extra coupons, it's not extra issuance, I think there's going to be a little bit of a dovish relief rally across all assets. We just talked about bonds. I do believe that also in the FX space, what we could see is that the dollar index might actually sell off a little bit here. So the dollar selling off against its peers. Already on Friday, we saw a little bit of, since the Friday session, so overnight, we've seen a little bit of weakness here. And I do believe that if we don't get any surprises, we could see the dollar coming down to, 104.8, 104.7, these areas down here. And that could be an opportunity at that point to maybe, put on some call spreads if those of you have sort of access to options and call spreads on FX. That would be a great way of playing it. And then maybe up then to 10, testing rehighs 106.5, even up to 107. Again, I think what's going to happen is that if we get no surprises from the US Treasury, there could be a sort of a dovish reaction. We get through the next few days, the data, maybe a hawkish Powell, and then things reverse after, let's say Wednesday, Thursday, and we go back to just sort of obeying the macro. We talked about the USD JPY. As I said, I think the same sort of situation there. Same kind of thing here for the euro. I've got a little note to myself, short USD on rallies. You see the euro here is rallying a little bit. And again, that could be a case that it rallies, but certainly I think up at 1087-ish up here would be a great opportunity to be shorting. That's what I'll be looking at. Also in gold, the reality is that gold is an interesting one. Reading something yesterday, gold has gone up a huge amount in yen terms and in Chinese renminbi terms, and also in US terms. So a lot of people are a bit confused, saying, well, why is gold going up when real yields are strong and nominal yields are strong? But the reality is, if you look at gold as priced in yen or gold as priced in Chinese renminbi, it's gone up a lot more powerfully than priced in US dollars. And I think what's happening there is that as those currencies lose value, and even in the case of Japan, start to be a little bit debased, losing, I think, 10 or 12% this year so far, a lot of retail money has gone into buying gold in yuan and yen. And also, of course, we have a lot of central bank buying by especially the People's Bank of China. So I think the point is that gold is probably a buy on dip. But in order to have a huge push up, I think what we would have to see is maybe a bit of strengthening in the yuan or the yen. And so that sort of impetus to be buying gold in those two Asian countries might just come off the boil a little bit. That's just like a bit of a side point here. But just in terms of gold, again, if we get a relief rally, there's no reason at all why gold can't rally up to, let's say, about the 2400 level, which I've marked up here. I think that would be a good level. But for the reasons above, I think it'd be hard for gold to kind of push too much higher. And personally, at that point, might be interested in buying some put spreads, maybe 2400 down to 2300 on GLD, or those of you who have access to options on futures, that would be a perfect way of playing that as well. So something like 2400 down to 2300, some put option spreads there would be pretty interesting. And again, and that might get down to maybe like a 2260 level. That's a key level down here, where you see the congruence of a confluence of two fib zones, with the longer term one is the purple and the shorter term one and the green. So that's a key level there. So be looking to sell here and then maybe to re-enter on along there. And again, it's the same theme that after the QRA, we might get a bit of a dovish relief for a day or two. And who knows, that might be smacked down by Powell. In terms of other commodities, we had copper at a pretty interesting level on Friday. This was a bit of overhead resistance here. It looks to be breaking out. You see it's a big level there going all the way back. But that does seem to be breaking out. We do have the contract rollover, which happened, I believe it's happening today or at midnight last night. And so it looks like copper is breaking out again. And that has, a lot of air above. So at this point, you'd have to start looking at Fibonacci extensions and target profits. Although if you look at the Fib extension, it has overextended a little bit. So one could argue it's a little bit oversold, but at this point, it did retest this level on Friday around about lunchtime or so, and is now pushing higher. So copper looking strong. The one other thing I just want to look at here is oil. I think oil is in a little bit of let's have a look at oil here. Just in a bit of a sort of a trade range here. For me, this is not an attractive moment to either go long or to either go short. I think certainly if it gets back down to these levels at 80.5, that would be a great price to go long. And obviously up here would be interesting to maybe double short. But I think at this point, I'm going to leave gold alone for a few days at least. There's other stuff happening. There's no particular sort of geopolitical driver just at the moment. Came off a little bit. There was some talk over the weekend, a final push by the US Secretary of State to try and stop the Israelis invading the township or the town of Rafah. There seems to be a lot of support in the Middle East from the Saudis and the Egyptians for no more further escalation. So at the margin, that could be a little bit bearish for oil. But the reality is that the oil, the premium for risk of oil has been taken out, I think. So I don't really necessarily see that as a catalyst for oil to be collapsing anytime soon. Okay, just finally, guys, just want to have a look here at the S&P. I'm going to use the cash index, the SPX, just for the levels here. First thing I just want to say is there's a 5180 up here, which is in the orange line here. Very, very key level. Again, could it get up there on a relief rally? Again, my point is that we have a lot of earnings this week. Let's have a quick look at them. We have Apple on Thursday, I believe. Yeah, so we have Apple after the close on Thursday. We have Qualcomm. We have Amazon and AMD. I think this is pretty important for the semis, AMD and Amazon tomorrow. Not a huge amount today, to be honest. Well, it's some interesting companies there, but maybe not the big heavy hitters. What is going to be interesting as well is tomorrow we have McDonald's and Coca-Cola, kind of, pretty defensive kind of stocks there. 3M is interesting. Lilly in terms of the, I think, do they do Ozempic or the other one? Anyway, sort of the fat loss drugs. We have Livy, and we also have Novo here on Thursday. So quite interesting in terms of the farmers as well. Cameco will be looking at just in terms of the uranium market. That's the big Canadian uranium miners. So that's going to be interesting. They've been doing pretty well. Those of you who follow LNG, sort of nat gas, Cheniere is reporting on Friday morning. That's quite an interesting one. And Hershey's bit of a strange one, the candy company, but we all know that the cocoa has been going crazy in the last few months. There's a huge global shortage of cocoa. Hershey, of course, is a big chocolate maker in the commercial field. So just interesting to see if there's any sort of comments there about the future of the cocoa market. But just getting back to the index, if we go back to the SPX, as I say, if we do get anything sort of relatively supportive from the Treasury, so again, just repeat, no extra coupon issuance or unexpected coupon issuance, and a gross issuance relatively in line, I think that, at the margin will support all assets, including gold, including bonds, but also including the equities. Why not? And, the earnings have been okay this season. And just something to note about the equities earnings is that the multiples are pretty high, and the market has been punishing companies which have fallen short of forecasts. So it's not so much rewarding companies which have come in with good forecasts. It's more like punishing those which have missed forecasts. So there is a bit of fragility in the market, but I do believe that, especially, we have a few days before the Fed and Amazon, that if the Treasury doesn't disappoint, there's no reason why the SPX can't get up to 5180 or so. And I think that could be a first. That's a reasonable thing to be doing, is to be buying equities up to 5180, 5200. And then, of course, we at that point, we might get a little bit a little bit of hesitation. So at that point, let's say by midweek, we start getting to issues, things like sort of the Fed. And if Powell comes in sort of hawkish, if maybe on Wednesday, who knows, maybe the Treasury coupon issuance is not so great. Definitely at that level, I think it starts to become interesting. not for a huge pullback of 10 or 20%, but maybe equities at that point, if there starts to be a rise in the term premium, a sort of a hawkish pushback from Powell, maybe that could be the opportunity to buy some kind of put spread, long put spread, maybe with an expiry of 2, 3, 4 weeks, something like that. Maybe with a correction down to maybe something like firstly down to 49 and then maybe to 40, 4,800. So maybe some kind of spread. I don't know, maybe, down to like the, 5,000, 4,900, 4,800, this kind of area here. And at that point, I don't think it necessarily the stocks have to sell off anymore, but just another little sort of test downwards, I think would be relatively reasonable. I think what's also interesting is that the European stocks are looking quite solid as well. They have lower multiples in general than the US, so it's kind of better value. So is there going to be a theme of sort of catching up over the next two or three months? Also keep in mind that the Eurozone may be having lower interest rates than the Fed or over in the US. So there could be like a sort of a divergence in monetary policy and also more attractive sort of multiples in the sense that less expensive. So keep an eye, any sort of dip here to 47, what is this level here? About 47.65 on the Euro stocks, I think would be a great buy entry just to retest the top. Also, emerging markets are doing quite well, and that's something to keep an eye on as well. I mean, could emerging markets get up to, let's say, 42.25, something like that, or even up to 44? And this looks a bit like a late entry here, but if you actually put it with the chart with a little bit more historical perspective, you could see that it wouldn't be a problem really to test up to this, what's that, about 42 level. And once we get above there, it could push a little bit higher. Again, based on a sort of a pro-growth sort of environment, which we don't necessarily are seeing at the moment. So that's a maybe, but that's definitely something to keep your eye on. Again, the Nikkei, if we just get over a little bit of sort of strength in the relative strength in the yen in the last sort of few hours, the Nikkei is getting to a point here which is quite an interesting level, which in fact I'm going to mark on my chart here, that if we can get down there, that would be quite an interesting buy level, because I think as the yen presumably might start to weaken again, we could try and have a retest of the highs on the Nikkei. So definitely that's kind of an interesting one. Finally, guys, just want to talk about the FOMC. I might do something in greater detail, but I think the point here is that the Fed was looking for more confidence, and they haven't really received more confidence from any of the data. And so I think at this point, we have to say, just looking at something here, if we just look at what's priced in, if we look at for obviously the June meeting, only 3 basis points is priced in, May absolutely nothing. And then if we go to December, only 35 basis points, or about 1.5 cuts are priced in. And so what's kind of interesting is that if we go, let's say for December, and we put it on maybe like a 30-minute chart going out, let's say a couple of months or so, you can see here that since the last meeting on which was when was that, January or so, basically the market here has priced out a lot of cuts, So here we only got 35 basis points of cuts by the end of this year. And if you go back to, the most recent sort of Fed meeting, when was that? Hold on, I have to think now. Where are we? That was March, I think. In March, Yes, I think it was here-ish. Yeah, March, beginning of March here. That was about 80 basis points. So my point is that what good would it be for Powell to be sort of take June off the table, because the market has essentially done that. There's only 3 basis points priced in for June. So there's little incentive for him to take June off the table. What would be hawkish is if he took July off the table. But I think it's most probable that Powell will repeat the fact that they have not enough confidence. In fact, they've lost confidence in the direction of travel for inflation, and that there's no urgency to cut, and that they will remain as ever data dependent. So I think at this point that's not really a shock. What we're probably more interested in to see is if they start to taper QT or something like that. But I think really the Fed is probably going to be less of a concern for the market compared to the QRA, and of course the data. And again, just look at the data. We have a lot of employment data, and I want to draw your attention, especially guys, maybe a lot of people are not really talking about it, but we have the quarterly employment cost index. So the totality of cost of employing someone. So it's holiday pay, sick pay, social insurance contributions, not just freelance kind of gig economy kind of people. And we're getting that tomorrow at 8:30 a.m. And that's a big input into inflation. So I think the Fed will be looking at that, and I think the market will react to that. So that's at 8:30 a.m. tomorrow. Then, of course, on Wednesday, we have the ADP. We have JOLTS at 10 o'clock, along with ISM manufacturing. So that's a pretty big one there, just a data dump there. We have initial jobless claims, unit labor costs again on Thursday. Then, of course, we have non-farm payrolls and ISM services on Friday morning. So a lot of data. And by the end of this week, we will have a lot more information. Is the labor market showing any signs of cracks? Is inflationary pressures in the ISMs? How are people thinking about the future? So a lot of data, and the market, to be honest, could go either way. If the data starts to show cracks and the QRA is not aggressive in terms of issuance, that could, and Powell doesn't particularly say anything unexpected, there could be some kind of relief rally. On the other hand, of course, if the QRA, if the Treasury surprises by drawing down the TGA, by issuing more long-term coupons, if Powell is extra hawkish and sort of takes hikes, maybe even talks about the potential for hikes, oh my God, that would be hawkish. And let's say all of the data in general is hawkish. Well, for sure, of course, we could get some we could get bond yields going up significantly. We could get the front end under a lot of pressure. And ultimately, we can get the term premium rising, and we can get stocks under pressure as well. And who knows, maybe some of the earnings like Apple will be less than stellar. So it's going to be an interesting week. It's very difficult at this point, in my humble opinion, to be making long-term macro calls. Personally, I'm going to be just trading, some of the basic macro instruments, your basic currencies, your basic stock indices, and the base kind of US Treasuries, and trying to have short, sharp tactical trades based on my best viewpoints reacting to the data. Of course, as I say, between now and Friday afternoon, a lot could happen in a dovish or a bearish way, and we just don't know. What I would say, keep an eye. I mean, I know it's Friday night, but just interesting maybe over the weekend to review that. At 7:45 p.m. on Friday, we have Williams, head of the New York Fed, and that'll be the first major sort of person from the Fed to react to the data and everything at the end of the week. So that'd be something interesting to look out for over the weekend, just in terms of how the market might open next week. But that's about it. So I'll leave it there, guys. Have a great week, and let's keep on talking. Thanks so much.